Hello and welcome to The Firm. On the show this week, will QFI open the doors to a new breed of foreign investors? Will it work? And CCI's 6,300 crore rupee bombshell on cement companies found guilty of cartelization. The qualified financial investor route was opened up last year to facilitate foreign investment in Indian mutual fund schemes. Since then, the QFI has been widened, tweaked and guidelined, and today foreign non-institutional investors or QFIs can for the first time invest in Indian mutual funds, equity and listed corporate debt. That sounds nice, doesn't it? A whole new class of investors to help companies raise funds, deepen our equity and debt markets and give mutual fund performance a much needed boost. But is it as simple as it sounds? Well, today we examine the QFI concept and process design for ease of use and attractiveness. And to do that, I have with me Anand Rengarajan, Director and Head of Direct Securities Services India at Deutsche Bank. Now, Anand accompanied the government on QFI roadshows in the Middle East last week. So hopefully he has all the answers to our many questions. Also with me, Bobby Parikh, Managing Partner at BMR. Bobby manages its financial services industry practice as well. In Delhi, Pratibha Jain, Head of Nishit Desai Associates Delhi Practice. And joining me from London, Martin Hattrell, Partner at Slaughter and May. Gentlemen, Pratibha, to all four of you a warm welcome. My first question is to you, Anand. This opens up a doorway for individual foreign investors, for companies who want to invest in India, to come and directly invest in India's secondary markets, equity, listed corporate debt, and through mutual funds as well. Can you tell me the broad categories of investors that you're hoping India will attract through the QFI scheme? And do you see those investors, erstwhile P-note investors, those coming through the FII sub-account route, those investing on the Singapore Stock Exchange, trying to get some India exposure, all of them wanting to come through this route?
The objective of a new route, I mean, we already have 4 existing routes for investors to get into India, right? The one very common everybody knows is the FII, you have the FDI and the FVCIs. We can look at ECBs as well as a part of it, but we'll just leave that for the moment, right? And we now have the new one, which is the QFI. This is basically meant to complement those 3. It's not meant to replace either of them. So, you know, it's basically the objective is to get fresh new flows into India. So if you talk about that, you would talk about those who don't qualify for FIIs today.
Right. So individuals for sure.
Individuals for sure.
Right.
So if you individuals for sure. And again, I normally would like to break that into 2 categories because there is a bit of an analysis on that as well. You would talk about pure retail individuals and more the high net worth individuals.
All right, yeah.
And that's how we break them. And outside of that, 2 really big segments which have shown interest in the past, and they are all quite excited to hear about the new QFI is the family trust offices,
right?
Who would never like to be broad-based.
HNI linked to some extent,
correct.
Right? HNI linked, the family office.
In a way linked, yes. And then the last category, I would call it is the corporates.
Right.
Pure corporates who always had a fair bit of interest, and now this gives them an opportunity to get into the market. So these are basically the
So are you saying that those who come through P-notes, which are not individuals, because I'm told individuals can't sign up through P-notes or can't invest via P-notes, or those who come through FII sub-accounts will not be interested in these categories? I mean, those, they don't overlap, they do overlap. How will it work?
First of all, the regulation clearly states that it is mutually exclusive. A QFI has to be mutually exclusive to the FII.
Right.
So if somebody is already an FII, why would you want to...
No, but if somebody is not an FII, but is a financial institution investing via Q-notes or P-notes or investing via FII sub-account, would they be allowed to come through QFIs?
They could, they will, but the question to ask is, what the P-note guide does today, right? So besides listed equity, which is common for both, he also does a lot of structured products, which is not permissible for a QFI. They do a lot of things on the futures and options, which is not permissible for QFIs. Plus,
so to interrupt you there and to move it on, you're looking mostly at individuals, family offices, and maybe corporations. Those corporations that were not already coming through the P-note or the FII sub-account route might now want to come through the QFI route. Correct?
Yeah.
Bobby, do you think that's opening up a whole new category of investors and bringing them to India? What do you make of it?
I don't know the size of the addressable market.
Impossible to gauge,
in a manner of speaking, but I think that it certainly does open up a bunch of potential investors, and I think the family offices and the wealth management clients of large wealth managers will be clearly people who would have an ability to invest in Indian securities, which they didn't have so far.
Right.
And they would not have. It might have been difficult for them to qualify for being P-note holders. And therefore they wouldn't have had the indirect access either.
Martin, would you agree with that?
Well, I would have thought that the high net worth individuals and the family offices would find investment in Indian securities very interesting. Growth is hard to achieve at the moment in Western economies and stock markets, and so it will, I'm sure, be of interest. Whether corporates would do it if they were able to invest through another route, I'm not so sure. But anyone who cannot go through another route to invest in Indian securities, I'm sure will find this of interest. Sure they will.
All right, so we've narrowed it down to individual retail investors or individual high net worth investors as the beginning addressable audience.
I think most likely, yes.
Yeah, all right. The Pratibha, look at the process that has been laid out under this QFI scheme and tell me whether you think this category of immediately addressable investors will be keen to come to India using this particular process. Does it provide ease of use?
Menika, firstly, if I may, just, I think, what others have said is right. Immediately, based on the current regulations, you're probably looking at individuals or some corporates who haven't yet registered as FIs and find this easier, because there's still a lot of cleaning up for the government to do in terms of bringing the regulations at par with the FIs regulations, especially I think we're going to talk later about tax. But I'm hoping that in the long run, this is not just about creating another class or another route of investors, but hopefully this is the path we are going down for foreign investors to invest in the country. That is, i.e., you don't have to register with the regulator and go through the lengthy process, but you can actually do a bit of self-regulation, register through an SRO or an intermediary, meet the requirements, and we can streamline the process for a foreign investor to come into India. So just on the hope that in the long term this is where the government is going. In the short run, I think they're trying very hard to make this route a feasible route, a comfortable route for the investors to come in through. KYC requirements in India are always painful. It's procedural. You have to meet the procedural requirement rather than the substantive requirement. And whenever we talk to foreign investors, they find it the most painful, giving their personal details, their passport copies, getting a PAN.
Or in-person verification.
Yeah, going through the in-person verification. Though, in the latest FAQ, they have clarified that for foreign offices, they would consider attestations and going through notary publics or courts in foreign jurisdictions. But it's still cumbersome process. And you compare that for at least a category of investors who can come through the P-note route or have exposure to the Indian market, they'd rather stay outside.
The entire premise of QFI is supposed to be a single stop window, right? So as you mentioned, no SEBI approval, everything stops with the QDP. That was supposed to be the premise.
That's right, but even if it stops with the QDP and it's a single window process, is the KYC too cumbersome?
KYC is very similar for an FII, it's very similar for this. There's
but
no change in the
FII
laws.
are institutional investors. You've narrowed the immediately addressable category down to individual and high net worth individuals, right? So retail and high net worth individuals. For an institutional investor to go through a painful paperwork process is different as opposed to an individual guy having to do it, right? Smaller amounts of money, you don't want to go through that cost just to invest in a foreign country where the risks are anyways, difficult to deal with. So how did you answer all of these questions in your roadshows?
The roadshows actually, the questions were more around, is this the right time, around the current applications, not so much on the process side. They all assume that it will be a single window process that works quite well.
Deutsche Bank is a QDP as well, a qualified depository participant, and just to clarify for our viewers, a QFI can come to India only through a QDP.
That's right.
and give instructions for trade purposes through the QDP, even if they have a preferred set of brokers, correct?
That's right.
Yeah, through one non-interest bearing rupee account. That's the process. You're a QDP.
Yeah.
How do you deal with the fact that the KYC norms are painful, they're difficult, and the burden of this is on the QDP. So the QDP is going to have to deal with hundreds, if not thousands or millions of individual investors, making sure that, all their bona fides are in place, and yet sell it to them, whereby it doesn't sound like a very onerous process.
I mean, there have been a lot of representations made on the KYC process, right? As Pratibha was mentioning, that we have also asked for a lot of changes, some of which have already been mentioned, but they may not be in paper. But they are, for example, changing a form which is a combined form for KYC and PAN application, so that you have to just fill up one form.
Right.
So there will be some changes. But
do they all need to have PAN numbers? QFI?
Yeah, the QFI PAN is mandatory, right?
That's a non-starter. That's a non-starter, right?
That's something which is there. It's not changed. They are trying to file, remove the obligation to file a return. But then if you want to get a refund, if you want to do something, then you have to still file a return, right? So that is the clarification on the tax part which is still awaited.
I'm very glad you brought it there. Now let me go to Bobby with this.
The whole QFI stuff actually goes back, in my mind, to a report which was published a couple of years ago, which was coincidentally UK Sena was the chair of that committee, and that committee was on portfolio flows. And the thinking that committee, I happened to be part of that committee at that time, the thinking was that we should really open up portfolio investments to everybody.
Correct.
So there should be no SEBI registration whatsoever. There should be no registration. It should be
a bit
open.
like what Pratibha mentioned right at the beginning.
Exactly.
Yeah.
And so the QFI term was actually part of that report.
Right.
And that QFI was meant to replace everything that was
including
there.
FII.
Including FII. So there should be no FII. Anybody who invests is a QFI, and that can be anyone that has to be there. Right. KYC, I think, you need to have some KYC. I think I'm not.
No, some is fine. KYC, which includes PAN cards and potentially filing returns, is not comfortable.
Yeah, now so okay. So that gets into an aspect of taxation.
Now please tell us what you think of the fact that we still don't know what the tax treatment is going to be. So what do you imagine it could be?
So one is that at an overall level, many countries in the world actually exempt portfolio investments from tax in that country.
Okay, but that's not what the government's talking about in this case.
So we are not doing that, but that was one of the thoughts that was discussed and debated in that committee, was to say that we should
chucked out of the window.
So capital gain should not apply to foreign investors who are at a portfolio level. So and portfolio being defined as 10% or whatever is the cutoff that the government wants to use, and there should be no tax. In which case we would have done away with PAN, we would have done away with filings, we would have done away with all of that stuff. Now, for whatever reason, we are not going down that route, so tax will apply.
Tax rates at this point in time is very similar to the FII structure, which is what he mentioned.
Very similar or same?
Same, basically, 15%.
Which actually is the base rate which applies to anybody that invests on the market. So in listed securities, it's 0 and 15 for everyone. So I don't know that there's a lack of clarity as far as equity is concerned. On debt investments, which is a window which has just been opened, some clarification will help, because if there's no clarification, the default rates that will apply will be higher than what apply to FIIs.
Now let's look at it from this point of view, right? You've got P-note investors or FII sub-account investors who were potentially not paying tax earlier. They may now have to, because the GAR cloud is hanging over all investments using tax haven routes, let's say. Would they look at QFI more favorably now?
So I'm not so sure, because I think that the P-note investors or the investors who invest through P-notes, there are, I think, 2 or 3 different elements that sort of drive them to choose that structure versus going through directly. So assume that there is a P-note investor who could also qualify as an FII, or could have qualified as an FII, and therefore that option was always available to him to invest directly.
Right. So now he can choose either the FII route or the QFI route.
He can today use.
And the tax is the same in both, so it wouldn't matter to him.
That's right. Assume that the P-note investors are the most sophisticated investors. So they'll want the FNOs and they'll want all of that stuff which is not available to a QFI. So logically they'd sort of prefer the FII to that. Right. The 2 things that sort of work, 2-3 things that happen with the P-note holders. One is of course tax. Okay, so that that's there today, or that's been available so far. That may or may not be available going forward. So maybe tax sort of drops away as a factor to consider.
Okay.
The other issue is just operating ease. that I just deal with my broker. I don't need to get involved with registration. Beyond that, I think that for the P note holders, the brokers actually provide them with other services. So there might be funding support, there might be all those kinds of things which would not be available. So I think the reasons why people will prefer P note route to direct routes will be for a combination of all of these factors. And so if one of the things drops away, there may still be other considerations which may
would force them to stick with P note as opposed to.
I think again, if you're comparing if one of the objective is to get the P note investors to come directly into the Indian market, and QFI is one way of incentivizing them, then registering in India through a PAN. We've had foreign investors directly tell us that makes them very uncomfortable, because that exposes them to the Indian tax authorities, which frankly right now don't have the best reputation. And then secondly, you've got to make sure that there is clarity, and this is again not specific to QFI route, but there's clarity on how we are going to treat our tax treaties.
It will be important that overseas investors have some sort of double tax treaty from which they can benefit, so that they see that they're not paying two tranches of tax.
When this was announced, all the QDPs wanted unilaterally PAN card as a precondition to be removed. Right, but that basically fell through, and they said the PAN is mandatory, but we could do away with filing of a return, because the PAN card presupposes that filing is mandatory.
Right.
The best they could do is at least address some of the other concerns. So for example, today if I have to still pay compared to an FII, can I offset my capital gains loss with earlier capital gains, and so on and so forth, right? So all these are left pending.
So if you want to simplify it and you want to say that, okay, as a flat tax, you pay the tax, you don't file returns, matter is over, then to have all these, then I think that the whole business about treaty exemption or not, or treaty relief or not, becomes an issue. Because if you're going to claim that, then someone would want to look at it to see whether you're eligible to claim it or not.
Right.
If you're going to set off losses or do whatever, then someone needs to verify whether you're doing it accurately and properly or not. Then the filing obligations come along with that. So if you want to do away with filing obligations, then I think you have to also give up
do away with all of this.
Then you say that, okay, I'm going to pay tax, and this is the tax, I get certainty, but I don't get some of these things.
On the tax front, and the other question I want to put to you on this, again as a QDP now, you're going to be the tax agent for the QFI, right? The QDP is going to make sure that the QFI has stored the tax line in India. So first you've got the KYC burden on your right shoulder, and then the tax agent burden on your left shoulder, and yet you've got 28 institutions that signed up as QDPs in this country. Why is that? Are you not uncomfortable about the fact that you have many lines to toe?
Most of the QDPs have a concern on that part.
And yet they've all signed up.
Basically, the definition of what our role is a tax agent is question, and that's being discussed, right? Clearly, if you look at what we do for an FII today, we are not a tax agent.
You do nothing regarding the tax.
All that we do is, once we get a certificate from the tax consultant, a CS certificate, our responsibility is to ensure that we have deducted the money that the CS certificate says to be deducted before repatriating the proceeds outside.
Yes, but that's not going to be the case
here. So we're going to continue that, but then we have an additional burden of being responsible for any deduction.
Which means you have to make sure that number is right.
Correct. And taking an unlimited liability of that sort.
So yet 28 institutions have signed up. So what are you smoking?
There has to be some, there will be some clarification on that. Otherwise there will be a question of, how do you weigh your risk and return here? Because your risk could be quite high if you're taking an unlimited tax liability risk.
Alright, gentlemen. Pratibha, I know there's a lot more we want to talk about regarding QFIs, but we're entirely out of time, so I'm going to use one short phrase to wrap it up: work in progress. With that, let's take a quick break on the farm. On the other side, the CCI 6,300 crore rupee bombshell on cement companies found guilty of cartelization.